It all comes down to the types of companies you're owning. A company can't pay a growing dividend for decades without being financially rock solid. These are industry titans with a wide moat, a strong competitive advantage protecting them from competition, like a trusted brand or patent. Built to last with strong balance sheets and predictable cash flow, dividend growth stocks are historically less volatile. Your mindset shifts. You stop obsessively checking your portfolio, knowing you own a piece of a robust business sharing its profits. While others panic sell, you calmly collect dividends, confident in your companies. If this breakdown is useful, hit that subscribe button. It's free and ensures you won't miss future videos on finding the best companies. Let's look at Procter & Gamble, ticker PG. You likely have their products like Tide, Crest, Gillette, and Pampers at home. This isn't a flashy tech company. Its business is built on everyday needs, providing stable revenue, evident in its dividend history. As of 2025, P&G has increased its dividend for 69 consecutive years through recessions and a pandemic, giving shareholders a raise every year. This places them in an elite group, Dividend Kings. Such a track record proves exceptional management. Someone who bought P&G stock decades ago and reinvested dividends would have seen their income grow exponentially. P&G perfectly illustrates a durable business with a wide moat, commitment to owners, and the power of compounding. So how do you find these companies? It's about knowing what to look for. Here are the most important checks. First, the dividend growth streak. Look for companies that have raised their dividend for at least 10 consecutive years. Dividend aristocrats with over 25 years are a great starting point. Second, check the dividend growth rate. An 8% annual raise grows income faster than 2%, aiming for growth that beats inflation. Third is the payout ratio, a critical safety check showing the percentage of profits paid as dividends. Under 70% signals a healthy, sustainable dividend. A ratio near or over 100% is a major red flag, indicating a potential dividend cut. Fourth, consider the dividend yield, but with caution. An unusually high yield often suggests investors fear an impending dividend cut. Often, the sweet spot is a moderate yield combined with a strong growth rate. Finally, look beyond numbers at the business itself. Is revenue and profit growing? Is debt controlled? A growing dividend requires a growing business. Dividend growth investing is a fantastic strategy, but not a magic bullet. A smart investor understands both pros and cons. The most obvious risk is a dividend cut. Dividends are not guaranteed and can be reduced, especially during recessions. Focusing on companies with long track records and low payout ratios lowers this risk, but doesn't eliminate it. Another thing to be aware of is potentially slower growth. Companies paying dividends reinvest less into their business. Their stock price might not shoot up as fast as a high-flying tech stock. You exchange explosive growth for stability and income. Finally, even the steadiest stocks are still stocks. Their prices will fluctuate, and your account will see down days, even as dividends roll in. The key is a long-term mindset to ride out dips without panicking. So what's the big takeaway? We started with the problem trapping investors, being stuck between high-risk casinos and inflation's slow drain. Dividend growth investing offers a powerful third path, providing two sources of return: stock price growth and reliable, rising income. Compounding can turn small dividends into wealth, and owning stable companies brings the sleep well at night factor. This isn't about timing the market. It's a patient, business-like way to build your financial future. Financial freedom is a marathon, not a sprint. Dividend growth stocks offer a steady ride to the finish line. Your first step starts now. Begin your own research. Look up Dividend Aristocrats and Dividend Kings lists and learn about the incredible companies on them. If you want to keep learning, subscribe to the channel. Thanks for your time today. Now, go build your future.
What if you could build wealth and create a steady paycheck for yourself at the same time, all with less risk than typical stock picking? For many, the stock market feels like a casino, a stressful gamble where you're always one bad headline away from losing your hard-earned money. We see stories of people getting rich overnight, but we also hear the horror stories of portfolios getting wiped out. But what if there was another way? A path that didn't just offer growth, but also paid you for being an owner? Imagine a reliable paycheck that lands in your account every few months, like clockwork. And what if that paycheck actually grew, year after year, outpacing inflation and building real, sustainable wealth? This isn't an investing fantasy. This is the reality of dividend growth investing. It's a powerful, yet overlooked, strategy that patient investors have used for decades to quietly build fortunes. Today, we're breaking down the secrets. We'll show you how to turn investing from a source of anxiety into a machine for generating a rising income that can secure your future. Let's be honest, the modern dream of investing often feels like a nightmare. We're told to chase explosive growth, to find the next 100x stock. But for every huge winner, thousands of companies flame out, taking investors' money with them. It's an all-or-nothing game of predicting the future that leads to constant anxiety. The safe options aren't much better. You can stick your money in a savings account where it's protected, but it's also being eaten alive by inflation. You're stuck between a rock and a hard place. The casino of high-risk stocks on one side, and the slow, guaranteed loss of your spending power on the other. What we really need is a strategy that offers the best of both worlds: growth, safety, and a reliable income. This is where dividend growth stocks come in. So what exactly is a dividend growth stock? When a profitable company makes money, it can share a piece of those profits with its owners, the shareholders. That payment is called a dividend. Dividend growth stocks are companies that not only pay dividends, but have a long history of increasing that dividend every single year. This brings us to our first secret, the 1-2 punch of total return. Your profit from a stock comes from two things: the stock price going up and dividends. Most investors only focus on the first part. With dividend growth stocks, you get both. First, as these healthy companies grow their profits, their stock price tends to follow. But second, and this is the game changer, you get that steady, rising income stream. Because these companies raise their dividend every year, your paycheck gets bigger over time, acting as a powerful shield against inflation. In years when the market is soaring, you enjoy the growth. But in years when the market is down, you're still getting paid. This changes the psychology of investing. Instead of panicking, you can use those dividends to buy more shares at a lower price, which generates even more income. If getting both growth and income is the engine, then compounding is the turbocharger. When you receive a dividend, you can take the cash, or you can reinvest it. Most brokerages let you set up a dividend reinvestment plan, or DRIP, which automatically uses your dividends to buy more shares of the same stock. This is where the magic happens. Think of a snowball rolling down a hill. Your initial investment is the snowball. The dividends you get are the first layer of new snow. But next time, you get paid on your original shares plus the new shares you just bought. Your snowball is now bigger, so it picks up even more snow. Over time, this effect becomes incredibly powerful. Your shares generate dividends. Those dividends buy more shares, and those new shares generate even more dividends. It's a self-feeding loop of growth. Historically, reinvested dividends have accounted for around 40% of the S&P 500's total return. Ignoring dividends means leaving a huge chunk of potential wealth on the table. It's not a get-rich-quick scheme. It's a get-wealthy methodically plan, powered by patience and the unstoppable force of compounding. Perhaps the most underrated benefit of dividend growth investing is the peace of mind it brings, the sleep well at night, or SWAN, factor. This strategy is the antidote to the anxiety of high-risk speculation.